All right, so now we're getting into the second part of Chapter 10. Let's go. Now we're going to talk about exchanges of assets. So an asset received in exchange of non-monetary assets generally is valued at fair value. So the old asset has a fair value, traded in, the new asset has a fair value. The difference is usually paid with cash or other assets. So here you're exchanging an old asset for a new asset and either paying with another asset or cash for the difference. Gain or loss is recognized in these transactions for the difference between the fair value and the book value of the asset given. So let's look at these steps. Step 1, we record the new asset at its fair value. What is fair value? Is determined based on the fair value of the asset given up or the fair value of the asset received. In normal exchange, they should be equal. The second step, remove the book value of the non-monetary asset given to pay for it. Remember, book value is the cost of the old asset and the accumulated depreciation. Record any cash received or paid in the transaction. And then record any gain or loss on the exchange. And that's determined by taking the fair value and book value of the asset given up in step 2. If fair value is greater, then a gain is recorded. If book value is greater, then a loss is recorded. So 4 steps. Let's take a look. The Elkhorn Company traded its old laser equipment for newer air-cooled ion laser equipment manufactured by American Laser Corporation. The old equipment had a book value of $100,000, cost $500, accumulated $400,000. The old equipment had a fair value of $150,000. Elkhorn also paid American Laser $430,000 in cash as part of the exchange. So we will debit the new equipment for the fair value. It has. What is that? It would be the $150,000 fair value of the asset given, the old machine, plus the $430,000 in cash. That's what the company gave them. That's the fair value. The cash will be credited. The old equipment's cost will be credited, and the accumulated depreciation related to the old laser equipment debited. So the company gave up an asset worth $150,000 in this exchange that had a book value of $100,000. So there was a gain on the exchange of the asset. And there it is. What if instead the old equipment had a book value of $100,000 and a fair value of $75,000? And Elkhorn also paid $430,000 in cash. Well, now the equipment would have a fair value of $505,000. $430,000 in cash plus the fair value of the old equipment. The old will be removed, credit the equipment account, debit the accumulated depreciation, credit the cash. Because the book value is more than the fair value, the difference is a loss on exchange of assets. So when we're exchanging assets, maybe there's a little bit of money involved, we have to focus on what's the fair value of the asset given up compared to the book value. That will determine if there's a gain or loss. And there's those calculations. What if the old equipment had a book value of $100,000 The fair value of the new and old equipment is not determinable. American paid $430,000 in cash. Well, when that's the case, you'll take the book value of the old asset plus the cash. That's the cost of the new equipment, remove the old equipment, and credit cash. There's no gain or loss on the sale. So when there's no fair value that's determinable, you can't calculate a gain or loss. Now, instead, the fair value of both the new and old equipment is not determinable. Elkhorn pays $430,000. Oh, it's the same. Sorry. We're to a new slide. Sorry about that. It's just showing us no gain or loss is recognized. Oh, it's getting late in the semester. All right. Sometimes we have exchanges that lack commercial substance. What is commercial substance? Commercial substance is present when future cash flows change as a result of the exchange. For example, a newer model of equipment can increase production or improve efficiency. That would cause an increase in revenue or maybe a decrease in operating costs and a corresponding increase in cash flow. So commercial substance is present when future cash flows change as a result of that exchange. And that example explains it. When an exchange lacks commercial substance, the gain is determined by taking the book value of the old asset. When there's a gain situation, the book value of the old asset is used to record the exchange. If it's a loss situation, fair value of the old asset is used to record the exchange. Let's take a look. So now we have Elkhorn traded a tract of land for a similar tract of land. Well, they exchanged land for land. That lacks commercial substance. The old land had a book value of $2.5 million and a fair value of $4.5. Elkhorn also paid Sanchez $500,000 in cash. All right, when this happens, we'll credit cash for the $500,000. We'll credit the land for the amount, the book value of the old. But we debit the land account for the cost, the book value of the old, plus the cash, because it's a loss situation. A gain situation. Sorry, going back to that previous slide. These aren't my favorite thing in the world. These were just, I hear non-monetary exchanges, and it's one thing in accounting that makes me go, oh gosh, because there's just so many different ways of looking at it, right? So remember, if it's a gain situation, the cost of the new asset will be the book value of the old plus cash. So again, we record the new asset at the fair value of the asset given up plus cash paid. Now, if you receive cash, you subtract that. So this is fair value determinable, and the transaction has commercial substance. Step 2, remove the old asset, the cost, and the accumulated depreciation. Step 3, record the cash component, whether it's paid or received, and then record gain or loss. If there's commercial substance and the fair value is not determinable, book value of the asset given up plus cash paid is the cost of the new asset. Remove the old, record the cash. There's no gain or loss recognized. If you lack commercial substance and there's a gain situation, like we had with the land, the land's fair value was 4.5, its book value was 2.5. So there would have been a gain of 2 million. They say, nope, don't record the gain. Record the new cost of the land for the new land they're acquiring, book value given up plus cash paid or minus cash received. Okay, if there's a loss, you use the fair value of the asset given up plus the cash paid or minus the cash received. So Arizona Pharmaceuticals exchanged laser equipment with a book value of $70,000 and a fair value of $75,000 for a newer model of laser equipment. In addition, they paid $90,000 in cash. Arizona should, well, recognize a gain because the fair value of the asset they gave is more than the book value. Now, let's see, same kind. Arizona should record the new laser equipment at $165,000. The fair value of the asset they gave up plus $90,000. All right. So that is non-monetary exchanges when you purchase an asset with another asset. And they're, for the most part, you're not paying any cash. I mean, some of it is in cash, but not always. Sometimes you just exchange assets. Now our final area is self-constructed assets. So a company might decide to construct an asset for its own use rather than buy an existing one. Identifying the cost is difficult because there is no external transaction to establish an exchange price. So what do you debit your asset account for if you're building the asset? So, two critical issues with self-constructed assets is determining the amount of overhead to be allocated to the construction and deciding on the proper treatment of interest that you pay during construction. Now, why is that a big deal? Most companies take a construction loan to build facilities, buildings, warehouses, whatever, their offices. While they're in the construction phase, we're still getting that asset ready for its first use. So it becomes a question of, should we show all the interest that we pay during construction as part of the cost of the building? So we're going to talk more about that. The same with how much of these other costs besides direct labor and direct material that we can track that is actually in the building. Things like the number of nails, okay, or the amount of electricity we use, or things like that, that maybe it's hard to track those. Those are overheads. How do we determine the amount to add to the building account? So overhead allocation can be done in what's called the inclusion of only the incremental overhead costs. So what we would look at is what's the cost we usually have. Now, since we started construction, how much more are those costs, electricity and things that increased besides the labor and materials used directly in constructing the building. Or we could take what's called a full cost approach, and that's cost accounting, okay? We're not going to focus so much on that here. We're going to talk about interest. So what we mean by interest capitalization is if we're building a building and we borrowed money to build that building, or we just borrowed money while we were constructing the building, should we add any of the interest we pay to the cost of the building? And the answer is yes. I think we're leading up to that, right? So the question is, how much? So the first thing we want to know is, and this is called interest capitalization, when you are adding interest to an asset, it's cost, that's capitalizing it. Qualifying assets are those that are constructed for a company's own use, as well as assets constructed as discrete projects for sale or lease. So it applies to both. And they're discrete projects. They're not you're making toilet paper. Okay? This is you're building a bridge for someone. You're building an office building for someone. So you're either building it for your own use or to sell it or lease it. Only interest you pay during the construction period or is occurs is even eligible to be used or added to the cost of the building or the asset that you're constructing. Next, how long do we have to calculate capitalization of interest? Well, it begins when construction begins and the first expenditure is made, as long as interest costs are actually being incurred. So if you don't have any loans, why are you going to calculate interest capitalization? You have no interest. So you made your first payment on the project and you have loans outstanding that are incurring interest. These loans do not have to be for the project itself. They're just out there. So that's the time period we calculate interest for, from the time it begins and the first payment is made through the end of the project. Then, how do we calculate interest? And we have to do a special calculation called average accumulated expenditures. So what we do is approximate the average debt. How much on average would we need in loans for construction? So we're going to show you this through an example. On January 1, the Mills Conveying Equipment Company began construction of a building to be used as its office headquarters. It was completed the next year on June 30th. Here are the expenditures on the project for contractors. So they show us the expenditures that were made through 2021 and those for 2022. Now, also, and this is what you want to be aware of, January 1, the company obtained a $1 million construction loan with an 8% interest rate. So this construction loan was taken specifically for this project. It has an 8% interest rate. Also, the company has other loans outstanding during the year, 2 of them. One's for $2 million in principal, the other is $4 million. So those are their balances. The interest rates are 6% on the $2 million and 12% on the $4 million. And both of these loans were outstanding during the entire construction period. Now, if you're saying, well, how's that possible? We're just keeping it simple. First, here's our steps to determine the amount of interest that should be added to the cost of this building. We're going to do it 1 year at a time. The first step is determine the weighted average accumulated expenditures. Here's how we do that. If expenditures incurred are fairly even throughout the period, the average would be found by taking the total for the period for the year and dividing it by 2. However, that's not what our situation is. Our situation is there were some in January, some in March, and then 6 months later in September. So they're not even. So because of that, here's what we calculate. If we borrowed money for that first payment of $500,000, how long would we calculate interest for? So how long would this debt be outstanding during the year? All 12 months. So all $500,000 should be used to calculate the interest for this year on the building. March 31st is our next payment of $400,000. So if we had to borrow $400,000 on March 31st, how long would we calculate interest for in that year? 9/12. So not all 400,000 would be used to calculate interest. Only 300,000 of it, because 9/12 was the outstanding portion during the year. September 30th, we take a $600,000 loan. Let's say, I'm not saying we don't actually take a $600,000 loan. That's how we kind of look at it. So we made an expenditure. If we had to borrow that money, how long would we have had to pay interest on it in 2021? October, November, and December. So the portion of the year it's outstanding is 3/12. So we only need to calculate interest on $150,000 of that loan for purposes of our construction. Remember, one more time, I'm pretending we would have had to borrow that money. They are the actual expenditures that were made, though. So of that $1,500,000 in expenditures actually made, we would need to calculate interest on $950,000 of it, the average accumulated expenditures. That's your first step. Next step, ask yourself, do I have a loan specifically for this construction? If the answer is yes, how much is it? And they did. They took a $1 million loan, has an 8% interest rate. If your weighted average accumulated expenditures, ours are $950, are less than the amount you borrowed to finance this specific project, the $1 million, and they are, use the construction loan's interest, 8%, to calculate the interest on this project for the year. Now, if you're sitting there saying, well, what if that 950 was higher? What if it was more than $1 million? We'll show you that in a minute. But as of 2021, this company should capitalize, not expense, but they should debit their building account for $76,000 of the interest that they pay during the year. So the total cost of the building so far at the end of 2021 is $1,576,000. The actual expenditures made of $1.5 million plus the $76,000 of interest that's debited to the building. Now, how much interest was actually paid during the year? Well, we need to look at our three loans. The first loan was the loan to finance the construction of the building. So 8% times $1 million, and that was outstanding all year, so a year's worth of interest, $80,000. The next loan was $2 million. It was outstanding all year, so 6% of that, or $120,000, is the interest on that loan. And then the $4 million times 12%. So the actual interest paid $680,000. The calculated amount was $76,000. And so if the calculated amount is less than your actual, then you use the calculated amount. If your calculated amount ends up being more than your actual, you can't capitalize more than you actually paid, right? So you would have to only capitalize the actual. Now, what happens in 2022? Well, the method of determining the amount of interest to capitalize from January 1 through June 30th, the end of the project in the second year. By using rates from specific loans to the extent of the specific borrowings before using the average rate of other debt is called specific interest method. The alternative is to use what's called a weighted average method. So we're going to see what happens here. So remember the prior example or prior Can you tell I want to get this done, right? No, I'm teasing. Using the previous illustration, what this is saying is, okay, how much in loans do you own? What are the principal amount of loans for the year? $7 million. What's the total amount of interest you will pay on all those loans? $680,000. If you divide $680,000 by 7 million, that gives you a weighted average interest rate of 9.7%. So you're just not focused on just the construction loan. Nope. You're looking at all your loans and saying, we're probably using some money from these other loans too, so maybe we should consider their interest rates as well in our computation. And that's basically what we're doing here. Another, and that should say, well, no, it's okay for weighted average method. Another way to calculate interest is kind of along the lines of what we just saw before in the first year. It says this: if you have a specific borrowing, your weighted average accumulated expenditures to the extent of that specific borrowing. Remember, they borrowed $1 million to construct the project. So when you calculate your average weighted accumulated expenditures for the year, the first $1 million of them, you will use an 8% interest rate to calculate the interest. If your expenditures, that average accumulated expenditures, are above that 1 million, you will use a weighted average interest rate to calculate the remaining interest. So what that means is, if you have a company such as this, we would take the remaining loans. We ignore the construction loan. What other loans does the company have? They have a $2 million loan that earns 6% interest. They pay 6% interest on it. And they have a $4 million loan that pays 12% interest. So overall, the other loans total $6 million and they pay $600,000 in interest. Divide the $6 million loans into the $600,000 of interest related to those loans, and you get a weighted average interest rate of 10%. So this isn't in the slide, but let's say our calculation for year one wasn't $950,000. What if our weighted average expenditures came out to be $1,400,000? Well, we need to calculate the amount of interest. I'm going to put another slide in. Okay, I'm back. Doesn't seem like I was gone, but I was. So what I did was I created a slide. Let's say in our example that we were just looking at, 2021, the weighted average accumulated expenditures ended up being 1.4 million instead of 950,000. How would we calculate interest to be capitalized? Now, if we used a weighted average interest rate, we would just use that 9.7% we calculated. But what if instead, and this is our choice, we first calculate the weighted average expenditures related to our construction loan at that interest rate, which, by the way, it should not be an 80% interest rate. In my haste, that should be 8%. So the first $1 million of 1.4 million will be calculated at 8%, the construction loan's principal and interest rate. The remaining 400,000 will be multiplied by that weighted interest rate we just determined in the prior slide on the other loans, 10% or 40,000. So there's two different ways to calculate the interest, and hopefully I didn't confuse you too much. I'm surprised that this slideshow, they missed this. So hopefully that fills in the blanks for you while you're working on your assignments, and we'll be going over that. Here's Walmart's example of a little disclosure note that they have regarding interest capitalization. So we're just showing you companies really have this and they have to report it. Let's say in January, the Mateo company began construction of its own storage facility. During 2021, $13 million in construction costs were incurred as follows. So you have the $2 million, the $4 million, the $4 million, and the $3 million. Mateo took out a $4 million 10% construction loan at the beginning of 2021 to finance this project. The company had $20 million in other interest-bearing debt, so those are the other loans, that they've already calculated a weighted average interest rate of 8%. So that calculation I just did a slide or two ago, they already did it for us. The facility was completed in early 2022. What amount of interest should Mateo capitalize? So there's our answer, but here's how we go about determining that. First, the $2 million that was paid on January 1 would have been outstanding all year. So all $2 million should be part of our average accumulated expenditures. The $4 million paid in March should only be considered outstanding for 9/12 of the year, or $3 million. The June 30th $4 million payment, only 6/12 is considered outstanding, or $2 million. The October 31st $3 million payment, that's only outstanding for 2/12. So we multiply the actual expenditure by the ratio of time it would have been outstanding for the year and add them up. $7,500,000. The first $4 million of interest is calculated at 10% because of the construction loan that was $4 million, 10% interest. But we need to capitalize interest on $7.5 million of expenditures. So the other $3.5 million, we will use the weighted average interest rate of 8%, or 680, so I don't know what that totals, but it would be the $4 million times 10%, or 400,000, plus the $3.5 million times 8%, which would be 280,000. 680,000 is the total amount of interest that could be capitalized. All right, that's self-constructed assets. The final part of our chapter, the next few slides, are talking about research and development. So research is a planned search or critical investigation to discover new knowledge that helps developing a new product or service. Development is translating that research into a plan or a design for a new product or process, or even improving existing products or processes. So they're two distinct activities. How much is R&D, research and development costs? Well, these include costs relevant to projects such as salary costs, wages, labor for the research and development personnel, the people working on these projects, materials consumed while completing research and development, the equipment being used, the facilities, any intangible assets being used, any costs of services you need to pay for for others, and some indirect costs. So, we have to use electricity. We're in one part of the building doing research and development. We don't get a separate electric bill. So we've got to figure out how much of the electricity should be charged to research and development. That's just one example. So there's different costs involved with research and development. When an asset is purchased for a single research and development project, the cost is considered research and development and expensed immediately in the current year. So if you buy a piece of equipment that you're only going to use for your R&D, your research and development, you expense it. But if you purchase an asset and you're going to use it for more than a single project, you will depreciate it. You'll include the depreciation related to the time you're using it for research and development in the research and development costs. So here's some examples of costs incurred for research and development, costs incurred that are not research and development. Research and development costs are immediately expensed. Laboratory research aimed at discovery of new knowledge, searching for applications of new research findings or other knowledge, design, construction, and testing of prototypes and models, or modifying the formulation or design of a product or process. When you are doing those types of activities, you are in research and development mode. Here's some examples of non-R&D, which may not be immediately expensed. Engineering follow-through in an early phase of commercial production. So now you're starting to make the product. That's not research and development. Quality control during commercial production. Routine ongoing efforts to refine, enrich, or improve the quality of an existing product. So that's not a special research and development activity. That's something you're always doing. So that's the difference there. Adaptation of an existing capability to a particular requirement or customer's need. So you're changing it just because somebody asked you to change one little thing for them. That's not research and development. That's in, you're now in the processing stage of it. Let's take a look. A SKU company made the following cash expenditures related to development of a new industrial plastic. They have salaries, supplies, purchase of R&D equipment. They had to pay for legal costs related to a patent, and then they paid for services performed in connection with R&D activities. So what's included in that as R&D? $14,200. So we would debit research and development expenses $14,200 and credit cash. The project resulted in a new product to be manufactured in 2022. They filed the paperwork, got the patent filing and legal costs, and that will begin into the amortization of the patent's filing and legal costs will begin in 2022. The equipment purchased will be employed in other projects. So I can't flip back to that prior slide, but included in these costs are $500,000 of depreciation. So here's the same example again, new slide, but same items. So the 10 million, the 3 million, the 1.2 million, and the 500,000 is what was included in the R&D expenses. Now that $5 million in equipment, since it will be used for other purposes, will be debited to the equipment, credit to cash. The depreciation related to it this year while it's being used in research and development is debited with the research and development expense. One more time. What about, and there's the expense going into that. I guess it wasn't in the original journal entry. So we would debit research and development expense $500,000 for the depreciation on the equipment while it's being used for R&D, credit accumulated depreciation equipment. Now what about these patent and filing fees? Well, this takes us back to the beginning of the chapter. Debit patent. That's not research and development. That is part of acquiring your patent. Debit that, credit cash. You have a new intangible asset. I don't know why they keep doing that, but, and here's how we came up with the total expenditures. $14,200,000 for R&D expenses. $5 million was the capitalization of the equipment, and $100,000. So that's the total expenditures. Some goes to expense, some goes to assets. Now, what about computer software? So it has its own special kind of rules. So we start research and development. When software reaches a technological feasibility. What the heck is that? So when the enterprise has completed all planning, designing, coding, and testing activities that are necessary to establish that the product can be produced to meet its design specifications, including functions, features, and technical performance requirements. So it's reached the point that it's a product. From the start of R&D activity to that date, you expense all the costs associated with developing that software. From technological feasibility to the date of the actual product release, now you're capitalizing. The cost of cloud computing arrangements are treated as the purchase of an intangible asset if both the customer has a contractual right to take possession of the software without significant penalty and the customer can run the software on its own or with an unrelated vendor. If either of these criteria is not met, the arrangement is considered a service contract and costs are expensed as incurred. Otherwise, they're an intangible asset. So just more information. R&D performed for others. So if you're doing research and development for another company, costs are capitalized as inventory because aren't you selling them your research and development? And carried forward into future years until the project is completed. Then you sell it, just like you would any other asset you own. But this is inventory. Startup costs. This refers to a one-time pre-opening costs. They include organizational costs, paying the lawyer to get you incorporated, accountants to help you get your tax stuff set up. Startup costs are expensed in the period they are incurred. So when they happen, expense them. When you have purchased research and development, so if it's developed technology, capitalize its fair value as an intangible asset and amortize it over its useful life. So sometimes we do purchase research and development, and you'll see that more in an advanced accounting course. If you purchase research and development from another company that it's still being worked on, capitalize the fair value of the research and development as an indefinite life intangible asset until it's fully developed. These are unique things. Back to startup costs. Again, they include organization costs such as legal fees and state filing fees to incorporate. Companies are required to expense all the costs related to a company startup and organization activities when they are incurred. They do not call them an asset and then expense them. No, they're done. Expense them now. And that's the end of chapter 10. So we went through a lot there, right? Focusing on our property, plant, and equipment assets, intangible assets, a little bit of natural resources, and all the ways we have that could be thrown at us to determine the costs. So when you buy them, when you self-construct them, if they're donated, if you buy them with equity, if you buy them with a non-interest bearing note, if they're exchanges for other non-monetary assets. So we have many different ways that we could purchase an asset, but also we have to be very careful with how we determine the cost. Okay, so that's it for the second part of chapter 10. Please post your questions to the discussion board.